Hello, traders, and welcome back to another episode of NTRR. Do you ever wonder why some trading levels seem to work like magic while others completely fail? The secret often lies in understanding order blocks, a powerful concept that can transform your trading if used correctly. Today, we'll dive deep into what order blocks are, why they matter, and how you can use them to sharpen your edge in the market. So guys, if you are interested in learning more about order blocks, please hit that like button and subscribe to our channel if you are new. Let's get into it. As part of our disclaimer, we use the NinjaTrader platform along with the NTRR risk-reward tool in our videos to manage our risk and rewards, demonstrating how we apply the concepts covered in each video to our intraday futures trading. The NTRR risk-reward add-on for NinjaTrader was developed by us as a result of an actual need being traders, just like you, operating in the futures market, which led to NTRR becoming an authorized NinjaTrader add-on vendor for creating this tool. So what are order blocks? Order blocks are areas on the chart where significant buying or selling activity occurs, often initiated by large institutions. These blocks represent zones where big players have entered the market, leaving behind clues about potential areas of interest for future price movements. In simpler terms, order blocks are like footprints of smart money. Now, how do we identify an order block? The key lies in inefficiency. Inefficiency occurs when price moves sharply in one direction, creating a gap between the wicks of candles, signaling that the market didn't have time to balance buy and sell orders. These sharp movements often start from an order block, where institutional traders step in with substantial volume to move the market. Order blocks can appear in different parts of a trend. They might be at the start of an impulsive move, signaling the initiation of a trend, or they could form mid-movement as part of the trend's continuation. Recognizing these zones is crucial because they highlight areas where price is likely to react when revisited. Imagine the price shoots up after consolidating in a tight range. That consolidation zone, marked by the last bearish candle before the bullish breakout, is a potential order block. When price returns to this level, it often presents a high-probability trading opportunity as institutions may defend their positions. Understanding order blocks is not just about spotting a single candle or zone. It's about grasping the bigger picture of market intent. These zones give us insight into areas where the balance of supply and demand shifts, providing opportunities to join the momentum or prepare for reversals. So, why do some order blocks work while others fail? That's where the rules come into play, and we'll break those down next. But for now, start marking those inefficiencies on your charts and see how price reacts when it revisits these zones. How to identify valid order blocks? Well, not all order blocks are created equal, and understanding the rules for identifying valid ones is essential for consistent trading success. Let's break down the 3 critical rules that separate high-probability order blocks from the rest, and how to apply them across any market. Rule number 1, inefficiency. A valid order block must create inefficiency in the market. Inefficiency happens when price moves quickly in one direction, leaving behind gaps or thinly traded areas on the chart. These moves indicate strong institutional activity, as large buy or sell orders drive the market with enough force to leave behind an imbalance. To spot this, look for sharp, impulsive price movements where candles leave minimal overlap between their wicks. For example, just like we have here, when price shoots upward from an order block, leaving behind a series of clean bullish candles, that inefficiency signals a valid block. Rule number 2, break of structure or change of character. For an order block to be valid, it must lead to a break of structure or a change of character. A break of structure occurs when price surpasses a key level, such as a previous high or low, confirming momentum in a particular direction. In this case, if the overall market direction is bearish, a break in close below this low is referred to as a break of structure, which signals a trend continuation. A change of character refers to a shift in market behavior, such as the transition from higher lows to lower lows in an uptrend, or the opposite in a downtrend. In this scenario, if the market is bullish, a break and close below the previous higher low is considered a change of character, as a bullish market typically forms higher lows and higher highs. These moves, break of structure or change of character, indicate that the market is more likely to respect the order block, as it becomes the origin point for a significant price reversal or continuation. Rule number 3, unmitigated order blocks. The third rule is that the order block must be unmitigated. This means price should revisit the zone for the first time since its creation. The idea is that institutional orders often don't get filled in one move, so when price returns, it's likely that institutions will defend the zone, leading to a reaction. Once price taps into the order block and moves away, the block is considered mitigated and should no longer be traded. Let's put it all together. Here's how these rules work in harmony. Imagine a bearish order block forms during a sharp sell-off, breaking a key support level with a change of character. Price later retraces to that order block for the first time, creating a potential shorting opportunity. The inefficiency, break of structure or change of character in our case, and unmitigated status, all align to make this a high-probability setup. By following these three rules, inefficiency, break of structure or change of character, and unmitigated status, you filter out weaker setups and focus only on high-probability trades. As you can see, this order block held and was never broken above. A short entry could have been placed at the start of the order block with a stop loss set a few ticks above it. However, in practice, there is a risk of experiencing a fakeout or a liquidity grab, where a candle's wick moves just above the order block to trigger stop-loss orders placed by retail traders before the market resumes its bearish downtrend. This scenario is particularly common on lower time frames, such as the 1-minute or 5-minute charts. Blindly placing an order without any confirmation on these lower time frames is not something we recommend. Instead, a more reliable approach would be to enter on one of these two inverted hammer candles upon their close, as they signal potential weakness or strength that aligns with your intended position. For even greater caution, you could wait for another change of character to further confirm your analysis before entering the trade. In the next section, we'll discuss how additional factors like market structure and volatility can further enhance your success rate when trading these zones. Order blocks vary greatly in quality and reliability, and even the ones that meet the basic rules can fail under certain market conditions. To improve your success rate, it's essential to understand the key factors that influence whether an order block will hold or fail. Let's break these factors down and explore how you can use them to trade more effectively. Before we dive in, if you're enjoying the video so far, please give it a like to show your support, and feel free to drop any questions you have in the comments below. Number 1. Market structure. The overarching market structure plays a significant role in the success of an order block. In a trending market, order blocks in the direction of the trend are more likely to succeed than those going against it. For example, in an uptrend, bullish order blocks that align with the dominant direction have a higher probability of holding, as they represent areas of demand in a market moving higher. Conversely, bearish order blocks in this scenario are more likely to fail unless they align with a broader correction or reversal. Another critical aspect of market structure is liquidity. Successful order blocks often form in areas where liquidity is available to fuel the next move. Liquidity typically accumulates around key levels such as swing highs, swing lows, or zones of equal highs and lows. In other words, exactly where stop losses might be placed by retail traders or existing unfulfilled orders. When price taps into an order block and simultaneously grabs liquidity from these areas, the likelihood of a successful trade increases significantly. If you're wondering, this example is taken from a 1-minute chart, demonstrating that these principles hold true and can be applied across any time frame. Number 2. Market volatility. Volatility is another factor that can make or break an order block setup. High volatility days often provide the sharp, decisive movements necessary for order blocks to play out successfully. These conditions are more likely to generate strong reactions from institutional participants at key levels, leading to significant follow-through. On the other hand, low volatility conditions can cause price to hover around an order block without a clear reaction, increasing the likelihood of false signals or small losses. Identifying high-probability setups during volatile times can be as simple as tracking the market's activity during key trading sessions or events. Number 3. Market trends and freshness. Order blocks tend to work better in trending markets than in ranging ones. In a trending market, the balance between supply and demand is more predictable, and order blocks that align with the trend are more likely to hold. For example, in a bullish trend, a recently formed order block acting as demand often provides an excellent entry for a continuation trade. The freshness of an order block is also crucial. The more recently an order block was formed, the higher the probability it will work when price revisits it. Market conditions change over time, and as demand and supply dynamics shift, older order blocks can lose their relevance. Trading a fresh order block ensures that you're working with levels that still reflect the current market sentiment. Number 4. Multi-time frame confirmation. Using multiple time frames is an effective way to increase the reliability of an order block. For day trading, start by identifying order blocks on a higher time frame, such as the 1-hour chart or 15-minute chart. Then, zoom into a lower time frame, such as the 5-minute or 1-minute chart, to look for confirmations before entering a trade. Confirmation patterns like a change of character or break of structure in the lower time frame can provide the extra layer of validation you need to avoid unnecessary losses. So traders, I hope you found value in this video and that it helped enhance your understanding of order block concept and trading. If it did, don't forget to hit the like button. It's a small action that makes a big difference in supporting the channel. And if you're new here, make sure to subscribe so you won't miss future videos packed with actionable trading insights. Thanks for watching, and I'll see you in the next one.